Okay, so I think we'll kick off because otherwise we might run out of time. I'm just going to say a few things to begin with, and then we can dive right into it. But you probably all know Eric. Eric is the CEO and founder of Stable Asset Management. They have a business that is in London and also in New York. Correct me if there's anywhere else that you guys have offices yet. No.
That's right.
And they're a fund that focuses on backing emerging managers across asset classes. And I just told Eric this as well, but when I heard from him about his business, it was from one of the best, or one of my favorite CIOs in Australia, of one of the really big pension plans, and she told me that I had to go and check these people out because they had some really, really good ideas that most people that people are talking about, but no one really executes on, whereas Stable actually really executes on this diversity. The diversity research really does prove that if you have quality in diversity, that you will get better outcomes. And I'm just I made a post the other day, and someone, I'll just start with some research that McKinsey, so back in 2014, McKinsey did a study that initially focused on the correlation between diversity at the top and corporate performance. And it was confirmed again by another study in 2017. And the study noted, and I'm quoting, companies in the top quartile for gender diversity in their executive teams were 21% more likely to experience above average profitability than companies in the fourth quartile. So yes, diversity is important, but quality in diversity is the key ingredient. So with that, I'm going to hand over to Eric for his insights.
Thanks, Alex. So yeah, today it's meant to be interactive. I have a few talking points prepared, and then would love to open the floor to questions or objections to anything I've said. But I'll try and get sort of the talking points out of the way first, and then we can have more of a conversation. So I'd love to start off by being slightly controversial and asserting that people tend to think about diversity the wrong way around. So often people are solving for diversity almost as if they want diversity for diversity's sake. But at Stable, we find that's a weaker argument than saying we solve for performance, and to get better performance, you need diversity. I think that's much more powerful. So for us, diversity is an output, it's not an input. We end up with diverse portfolios of investments because we seek certain backgrounds and certain personality traits in the managers we invest with that we think drive better performance. So I think we need to turn the whole diversity argument on its head to ensure its success, because if we think of diversity as an end in itself, I think often people think that promoting diversity is concessionary, that somehow it sacrifices return for other, abstract greater goods. And I think that's definitely another reason to do it, but it shouldn't be the main driver. So today I thought we'd start with data. Alex has alluded to it a bit. Then describe how we think of diversity, because I think the definition of diversity can also be improved. And then I'll touch on what traits we seek in the managers we back that result in diversity, and finally just how we think about promoting diversity. So I hope to get through that relatively quickly, and then happy to take any thoughts or comments. So when you're trying to change hearts and minds and then behavior, I guess by second order, I think it's good to lead with data rather than saying that this is a good thing to do in an abstract way. And cognitive diversity is empirically proven to generate superior returns. So it's statistically significant. There's a number of great studies that, even accounting for survivorship bias and otherwise, keep on yielding the conclusion that cognitive diversity yields to better performance. I think the Knight Foundation does a really good job of naming and shaming recently endowments and foundations in the US. There's a number of consultants. Willis Towers Watson did a great analysis of investment teams across asset classes globally last year, where diverse groups outperform those that don't have gender or ethnic minority employees. And in private equity, where there's less data because the number of minority and women managers is less, still, when you look at sort of 7-year lookbacks, 41% of diverse managers are top quartile. So that's pretty impressive overrepresentation. I think the conclusion is diversity pays because you get higher returns. And I've used the word cognitive diversity quite purposefully. So let's just touch on what we think of as diversity. There's really interesting data, and there's a book I recommend called The Diversity Bonus by Scott Page that really makes the case for this very powerfully. The diverse investing only leads to better performance if the objective of that diverse investment has been to maximize returns, and only if it builds cognitive diversity. So if you put people that look different in a group, but they all went to the same schools, or they went in the same analyst programs at the same firms, you don't actually get that diversity bonus. So just looking different is not really what makes you perform better. And for us, we think of diversity as a broader definition, right? So not only gender and race, but culture, age, religion, sexual orientation, all these aspects of diversity bring cognitive diversity in our view. There's a great example, the late Catherine Phillips from Columbia Business School. She had great examples where sort of handicapped people were working in design firms, and obviously that completely impacted the decision of, say, physical features. So diversity is pretty tangible in our view. So how do we end up with diverse portfolios? We basically seek certain background attributes and personality traits. And there's quite a number of them, but two of the more important ones, and the ones that are more multidimensional ones, are variant perception and resilience. So let me touch on those two in turn. Variant perception to us is really the key to making money when you invest, right? You need to believe something that others don't, or you see something that others don't. It's a contrarian point of view. And to be contrarian, you need to be comfortable in the minority. And by definition, I think people from diverse backgrounds have grown up in the minority. So they make more investments that are more likely to deviate from the consensus. They're used to and comfortable being outsiders. So that's something that can take many shapes. The second is resilience. So we look for passion, we look for the ability to overcome adversity. And we think that if you come from diverse backgrounds, you've often had a tougher time to get to where you are. So there's some really interesting research from the National Bureau of Economic Research that shows that managers from less privileged backgrounds often have to, work harder or be more talented or both than the rest, because they need to overcome more obstacles and get less help along the way. And this takes many shapes again. So there's higher barriers to entry. Poor background managers don't have an uncle that can get them an internship at a brand firm. Even just retention, once you've gotten in, benefits wealthier managers, because promotions are less sensitive to their performance. They're more likely to be promoted for reasons unrelated to performance, like who their dad is, or if they're the member of the right club. And also, it's pretty demonstrated that social status at birth serves as a signal of quality, to enter the industry, which means more wealthy managers get access and by definition reduce the average quality. Another aspect of diversity, which again might be related to more typical diversity parameters, but I think is an interesting one in itself, is just how adversity in your life makes you more resilient, right? So there's this theory called Phaeton theory from the 70s, argues individuals who show personal achievement often have experienced childhoods, that have parental loss, and there's some pretty amazing stats just in certain groups of overachievers. A third of US presidents lost their fathers, before they were 20. 65% of British prime ministers lost a parent before the age of 16. So I think that kind of struggle gives you resilience, and it also has some other second order effects, like it's found that it promotes the presence of significant mentors. These mentors you choose or they choose you, and maybe there's a better fit as well than necessarily your parents. And it's not all death and dramatic things. It's a divorce or a parent who has money troubles and you see them go through bankruptcy. All of those adversities, I think, are great resilience builders too. So I think it's good to take a broader mosaic of someone's life and understand, what drives them, what created the chip on their shoulder. And that, I think, is helpful to bring into the conversation of diversity, because it also broadens people's understanding. And I think it leads to more buy-in from a broader set of people. Because all these cognitive diversity sources, can affect a much larger population. So how do we promote diversity, or how does Table think about it? We think about it in two different ways. One is to increase the base. So that means giving people more access to the industry and backing them. And that's what our firm focuses on. I'll talk about that in a second. And then you can also drive retention. So once diverse managers are in the industry, you need to encourage the promotion and retention of these individuals. Now, I think driving retention is best achieved by very, very large asset owners, because given their size, they have actually influence to change big firms. They can ask what team composition is, what is it on the investment side, across functions, seniority. And I think getting people to the top is very important, because it's been proven that ripple effect, as it's called, is pretty powerful. Firms that are owned by minorities and women and cognitively diverse people often hire and train, other women or people of color. And then they can tap into more diverse networks, because they typically have more diverse networks by definition, and that builds a better pipeline for, future talent. So it has this really great positive flywheel effect. But going back to the first action you can take about increasing the base, that's what Stable focuses on. So we provide investment capital and support to emerging managers. And by emerging managers, I mean, we back them early in their life cycle. So when they get started, or when they're still small and they need a catalyst, an acceleration. And this is a bit of a pet peeve of mine. I think the industry has a structural issue, which not enough emphasis is placed on getting managers on the ladder. Not everyone has that uncle to get them an internship. So we're founding partners of 100 Black interns. We offer internships through Girls Who Invest, who you mentioned, who we also sponsor. Girls Also Invest, GAIN is the equivalent in the UK and Europe. And so, I think this is important, because not everyone comes from households where finance is discussed at the dinner table, or attends schools where you get trained in presenting and public speaking, which is pretty critical for raising assets. And a lot of diverse manager programs, particularly the ones backed by sort of US pension plans, governments, and so forth, they are trying to increase diversity, but they can't take emerging manager risk, which makes no sense, right? The people who need the help is the early stage managers, but these programs are designed to help diverse managers, but they can only invest when the fund is already 500 million, which doesn't quite make sense, given that those managers have kind of already made it in a way. So just to finish off, I think one thing that can also be alluded to in trying to convince people that this is a great idea, other than data, and other than expanding the definition of diversity, I think to include more people, is also just, I think, appealing to people's selfishness, right? People who typically don't want to help diversity might be correlated with selfishness as well in terms of personal attributes. I'm going out on a limb there. I haven't read any studies on this, but a ton of studies show that wealth inequality that derives from a lack of promotion of diversity gives you less growth, declining macro fundamentals, eroded social cohesion, increased political polarization. I feel like that sounds vaguely familiar. So, all of those arguments are things that I think we can do a good job at promoting by painting a broader picture. And hopefully that means that more people see the benefit driven by returns first of promoting diversity. And I'll pause there. Hopefully I've said some things that are maybe new or controversial or otherwise interesting.
Thank you, Eric. They're very interesting. And just for everyone's background who may know Eric and Not 100 Women in Finance. So we're the largest global association for women in financial services. We represent over 2,000 companies globally with our membership base. We are in four continents, 26 locations, and actually this year we've been given a grant to start some locations in Africa, and we wholly agree with some of the points, or the points that you've made, Eric, but where you're focusing on. So we have, for our members, we have education events, we have peer engagement, which helps women to build peer-to-peer networks because virtue of the fact that there are just more men in the industry, they can build their own peer networks, whereas women sort of need more help doing that. But the real area that we're going to make change is in this impact pillar. And so we do all sorts of different events and fundraising things, but the money that we raise from corporates directly goes towards funding initiatives for our Vision 3040, which is, our vision is 30% representation of women in investment roles and executive leadership positions by the year 2040. And so why 30%? Because once you go from 30%, you actually go from being a minority voice to being a majority voice. And then you can overcome unconscious bias by the multiplier effect. So you have more women and diverse backgrounds. So we're focusing on gender first, but we also have affinity groups that we're working on for further minorities. So that's a lot of that's what we're trying to achieve. And then also in investment roles, so the executive leadership position and the investment roles are the most underrepresented by women in the financial services industry. And we figure if we focus on that one specific area, then the multiplier effect throughout the organisation of people working in business development or operations, etc., which are actually, there's higher representation of women, we will have an effect throughout the whole organisations. But the money that we raise from corporates then we'll go to building the pipeline. So we have we do things with what did you call it? It was Invest for Girls Invest or something.
Girls Who Invest, yeah.
Yeah, and then there's another one in the UK called Maths for Girls, and so we give money to external partners who already have these initiatives to build the pipeline, and then we're also doing our own stuff. But then, to Alison's point before, we also host the largest female-focused Cap Intro conference in the world, which will take place in September this year. Correct me if I'm wrong, Alison. And last year we had 200 female fund managers and 350 global allocators. So if you are let us know if you have an interest in joining that, because I know some of you are searching for female fund managers. But that's just a backdrop of 100 Women in Finance and sort of why we get along so well with Staple. They're a big supporter of ours. But let's go back to some of the things that you were talking about, Eric. So what is the difference then, I guess, between, in your opinion, we've got some people here who have $300 million and then some people here who have, look after 100 billion. So in your opinion, you think that what they need to do in the industry is quite different, and the way that they can have an impact to create this change?
Yeah, that's right. I mean, I think at the end of the day, to increase the base and get people on the ladder, there's work which is more to do with education and encouraging diverse background people to get interested in finance and apply to finance jobs. And that's what organizations like 100 Black Interns or Girls Who Invest do. And I think that's an activity for those types of organizations. Us who control, significant dollars, I think should be the next phase of that, which is once you've created enthusiasm for people joining the industry and make it more equitative, which hopefully means people are more inclined to apply and to give it a shot, as opposed to sensing these high barriers to entry, which I think exist, is to, once these people have reached a stage in their careers that they feel ready to launch their own thing, I think fostering entrepreneurship amongst diverse managers is very important. Of course, they can join existing firms, and then the important there of promoting and retaining that talent is something that I think large investors should worry about, because their dollars count more in the eyes of the leadership of those firms, whether we care to admit it or not. But then there's a small number of firms like Stable, which I think need to be focusing on also fostering entrepreneurship and actually creating these new firms led by diverse managers. And I think that ripple effect is particularly powerful there, of course, because when they set up these firms, those founders are already the leaders of these firms. So we don't need to wait 10, 15, 20 years to become the leaders of the big firms, which hopefully they will. They're leaders that day. So in a certain way, we're kind of time machining what we all hope will take not as long as it probably will take, which is increasing diversity in the short term. And I think that's a really important part of that equation. And I don't think there's enough allocators who are focused on that early life cycle stage. And that has to do, with valid risks, like emerging manager risk is a valid investment risk. It requires specific underwriting skills, like for instance, when that manager leaves a bigger firm and sets up his or her own, how much of that alpha goes with them, sort of organizational alpha versus personal alpha, something we spend a lot of time on. Was it the brand, the size, your boss, the risk manager, the systems? What was it that you leveraged to generate returns at your previous firm? How much of that is going with you, and how much of that isn't going with you can you replicate, and how long will that take you? Those investment risks are fair, obstacles to capital going to emerging managers. But then there's also another risk, which is less talked about, which is the career risk on the investor side, right? People aren't necessarily rewarded for investing early. It's safer for your career to invest in a large branded firm, because if things go wrong, there's more air cover. And I think that is something that needs to be talked about more. And that's, I think, where emerging and diverse mandates from large institutions and firms should be given the license to fail, or at least given the license to take that risk, that career risk, out of the equation, and actually reward taking emerging and diverse manager risk. And so that's how we think about it. Of course, you make mistakes, and I should probably fire myself on most days, but I probably will not, because I'm the founder. But other people need to be taking that risk as well.
Eric, if you don't mind, I have a question, not to Alex.
No, go ahead, everyone, please go ahead.
When you are, looking at a variety of different sort of strategies, I know you guys focus on the hedge fund side, but how consultative are you when you find someone who, can generate alpha, but, they just don't necessarily have, I don't know, I guess, quote unquote, the institutional background or processes in place?
Mm-hmm.
Do you look at them and recognize there's a lot of alpha potential here that could be good for your investors, and you act more as a consultant, or I guess, how do you work with those groups when you find someone that you really think has a lot of alpha potential?
Yeah, fantastic question. That's really, I think, the key to our success has been a focus on, money is great and important, but it's a bit of a commodity. Where can we make the difference? We can make the difference by being an operating partner to those managers. So let me explain what that means in our view. I think people forget that asset management is really two separate businesses. It's the portfolio and it's the business, right? It's two different things. And money will fund the portfolio, and money is important. But not all money is as green as other money. And that greenness, in my view, is related to, okay, what support do these assets come with? And the business we've built at Stable is very much saying, look, picking investments is tricky, picking managers is tricky, but when it comes to the business side of the equation, that should be something you can solve for with higher accuracy and sort of less error, because it's more of a science. Investing is still a bit of an art. So we put a lot of effort into building frameworks, processes, and support mechanisms with the managers we back. So what shape does that take? It's typically across operations and distribution. Those are the two functional categories. So on the operational side, we sit down with you, pre-launch if it's pre-launch, or early if it's early, and we go through best practices, anything from, HR to governance to valuation policies to compensation, and a lot of the softer stuff in this industry that tends to be a bit, macho and focused on money. I think a lot of the value is in things like talent management or how you design compensation schemes, or even, we always suggest to our partners of having informal and formal feedback loops every year with questions like, what are you doing well? What do you think you're doing well? What could help you do better? Those types of things that are fairly common in more corporate institutions tend to be lacking in asset management firms. So that's the operational side of the equation. And then the distribution side of the equation is more around, okay, let's review everything across the value chain, from the quality of materials to how you present. Do you have a meeting script? Do you have an FAQ? Is your data room in order? And a lot of marketing is not that intuitive, right? LPs have this love language that is not intuitive. And if you haven't been immersed in it, it's not that easy to learn, and it's definitely not intuitive. So we try and train you, what are investors asking when they ask this question? They're actually asking about this other thing that isn't clear. What things do you need to get out in a first meeting? And then it's also about using your time efficiently. So, we've spent more money than I care to remember on a Salesforce-based platform, which has pre-briefs on thousands of investors. And it separates them into life cycle stage and by asset class. Because as you mentioned, we have done a lot of on the hedge fund side and the public side. Over the last few years, we've also funded, venture capital, private credit, real estate related firms. And I find that investors is always a black hole of time. You can always spend another hour on the LP side of the equation. But the problem is the conversion rate, the efficiency is very low. And that's driven by the fact that most investors will take a meeting, particularly with emerging and diverse managers, because it's just interesting to see what's new. You're kind of ticking the box of seeing what's coming out. But 90% of those meetings are never going to invest in you in the first year or two. So it's a complete waste of your time to have those meetings early. You should just grade them by life cycle and focus your efforts on investors who do actually invest, in the first 12, 18 months. And it's like a video game. Once you get to these thresholds, be they AUM or tenure defined, then it's like, bing, level 2 opens and you can go after those. And I felt when I built my business, that was the side of the equation I had no idea about. I came more from a private equity background as an investment analyst. Never seen an LP in my life. I thought raising assets was going to be really easy, and it was the hardest part of the equation, really, because no one really teaches you how to do that. And so we try and focus a lot of energy on focusing our partners' energy on the right investors, and we try and use technology to scale that.
Eric, I'd love to ask you more about this, how you're thinking about diversity, maybe more broadly than others, which I find very interesting. And this I think it's spot on that, kind of by definition, the groups of people who manage the smallest portion of global assets have encountered diversity, if nothing else, in the process of raising assets. They've encountered adversity. But I guess I wonder, and because you're not talking about it from that end, how are you kicking the tires? And I guess, again, thinking about how you are working with your managers, I mean, you can't, I wouldn't imagine that you're proposing that they include a page in their deck saying, look, this is, these are all of the hurdles I've overcome in my life. But how do you think about that in your underwriting process? And again, how are you advising your managers to essentially kind of brag about this differentiated background, which is then informing their process and informing their alpha generation?
Yeah, great question. So you're asking about two levels. One is how we do it first, and then how we advise them to should I say, leverage that in their own asset raising. So obviously when we're doing it, we're asking these very detailed questions. We use a framework called past, present, and future. So we ask you questions about, what did your parents do? We try and triangulate, adversity, wealth, were you at a school where you were the only Jewish kid in a Catholic school, all of these things. And then present is more about, how do you spend your time now? What car do you drive? Are you flashy? What drives you? And then the future is more about how do you define success? And, there's no right or wrong answers typically in the latter, but in the first two, it's a lot more easy to discern these traits and backgrounds that we think have statistically impactful contributions to performance or to the prediction of future performance. We obviously focus on that, so that's a large part of our due diligence. Once we've decided to invest with you, it self-selects that you will have these attributes. And then when we go into designing your asset raising strategy, it is very much, as you say, of which parts of this, which pieces of the puzzle, which bits of this mosaic can we bring in your narrative? And I think there you have to be a bit subtle, right? So I think what I'm describing is not rocket science or new or no one does it. Some people tend to overemphasize that if they've been told to do that. I think there is a certain subtlety to, when describing your background, what you did. You can openly say, who inspired you, who first got you interested in investing and why, and all those things, as long as you weave them into a broader narrative and not become heavy-handed, I think that's important, because some of the adversity is obviously your gender or the color of your skin. That's fairly evident to everyone. But I would argue a lot of the things that aren't evident are probably even more, significant in driving the fact that you've made it where you have, and that's due to working harder and being more talented. And so I would just advise people to create a meeting script. I think we typically ask them to think about what are the types of sound bites that you want to share proactively. And hopefully, I think as the industry develops and hopefully as this approach that we advocate becomes more popular, it will also be a question of people asking you these questions, not just you volunteering them. And we are seeing that becoming, more important in people's diligence, because we obviously see the effect of that later. I will say, I think terming yourself a minority or women-owned business and so forth is fine. I think the most powerful pitches are those that don't necessarily reference that. Comes back to my suggestion that I think you should lead with your background and what makes you you and what drives you, more than necessarily sort of labels, right? And I think that's more powerful. So that would be one advice that I would give. Typically, I would just, it's evident to everyone. Don't make a big deal out of it and just talk about your background and experiences that aren't evident.
So Eric, another question for you. I guess from your fundraising standpoint, are you seeing a lot more interest from your LPs as well to leverage what you guys are doing for the industry and how you guys are approaching it? Because you really don't see, at least, I've been in the industry for, 10 years, more from a fundraising standpoint, and now more in a cap interest standpoint with being here at iConnections. What is your LP base looking like in terms of how receptive they've been with both returns and just really the approach that you guys are, or the gap you guys are filling within the industry? I know that might have been a whole lot, and might have been on a little bit more to some target, but I see a lot of interest and demand there. So curious to see it, hear from your standpoint directly. So
I think the last 12 to 24 months, there's clearly been an acceleration and absolute level increase in interest in diversity as, an aspect of underwriting. I'll go blue in the face saying that a lot of the behaviors we're seeing from some LPs are kind of going after diversity to tick the diversity box without framing it in the way that I take care to frame it, which is I care about returns, and I think diverse managers give me better returns than non-diverse ones. And it's really interesting, talking to the head of an emerging manager program at a very large Texas pension fund. When he gets asked by some of his peers, here's a group of emerging managers that we're invested in, and he calls them emerging, alluding to their tenure. And some of the peers say, no, I only want the diverse ones. He's like, no. Recipe for disaster. That's not what should be driving your decision. You should be more open-minded about how you want to construct an emerging manager program. And by the way, that pension has, I think, a 75% diversity allocation within their emerging program. But it's first and foremost an emerging program that happens to be 75% diverse. It's not a diversity program that happens to be emerging. And I think that's really cool. So I think there's a bit of a danger that when people get on the bandwagon of diversity over the last 12 months, I've seen a lot of people who weren't talking about it 3 or 5 years ago talking about it. And that's kind of like a bit of a marketing gimmick, a bit of an asset raising tool, and a bit of like, I don't want to be seen as the sort of outlier here that doesn't take this seriously. So I think that there's a bit of a risk that that then leads to bad outcomes. Because I think if you use a very stringent diversity lens, the outcomes by definition, because you're cutting out other manager diversity types or cognitive diversity traits, I think the outcomes will be worse. So that's what I'd say about kind of how the last couple of years have gone. Overall, however, I'm like super happy that this is more top of mind for everyone who's investing, right? That's great for all of us. I just think that there's this danger of it becoming then framed as this concessionary investing. And that will sort of defeat the whole purpose of what we're trying to do. So you have to lead with the data that it's actually better performing as well. And if you think about it statistically, if we don't get that right, in 5-7 years, the statistics will show that diverse managers are worse because the average quality will go down, and that's kind of interesting in itself.
Well, and your numbers have spoken for themselves. You guys have had a very good few years.
Yeah, I mean, I think again, is that because we're geniuses at picking managers? No, I think it's because we're fishing from a pool where the average quality is higher, right? I always want to load the dice in my favor, and we do that in those ways that we like the underdog, we like the person who didn't go to the top school, we like the person who had to fight to get that first finance job because they came from a family where they first to go to college or whatever. And so, again, I'm a selfish person. I do this because it makes more money. I'm really excited also that it has all these other positive externalities.
I don't want to keep taking up all the questions, so I'm going to see if anyone else has any. So I guess.
I have one.
Yeah.
I have one. Yeah. I just, and this is actually about. I had a conversation with someone recently who's looking to get from. Say they have $300 million and they have a female portfolio manager, but they only want to get to like $1 billion or $1.5 billion, and then they'll be at capacity. They'll be happy and everything. So what is it? A lot from what I understand, a lot of the emerging manager or seed or accelerator investors, they quite like to take a piece of the business in order to raise the capital. But if you've got a product that I can't remember what it includes. Maybe it includes small caps or something like that, where your capacity is only that you have X amount of money. If you're already at 300 million, then maybe you don't want to give away piece of the puzzle. So then what a piece of the business. So then what options, I guess, do those fund managers have to actually just, because they're too small to say go to the big institutions, because they'll be the ticket size won't be big enough and they'll take all of the assets. I mean, that's quite a difficult puzzle to solve for, I think.
Well, it's a nice problem to have. It's worse when you're at 30 and you can't get to 100, in my experience, because I've been there and done that. But let me answer your question.
Yeah.
Using our model as a template. So we do both what we call shared ownership investments and non-shared ownership investments. Shared ownership investments to us means we become partners in your business. We have a minority interest in your GP. And then obviously all this operating support from our business platform that I mentioned is very much the emphasis of our relationship with you, because we want you to grow. The typical rule of thumb in public markets is that we want you to grow 10 times what we give you. So if we give you 50 million, we want you to get to 500. If we give you 100, we want you to get to 1 billion. The way the cookie crumbles in the math, that allows me to hit my sort of 20% IRR, 2.34 net MOICs that I'm looking after in public markets. In private markets, it's a longer time horizon, and we think more in MOICs. So for our minority stakes, we give them typically another 5 years to grow from the sort of average 7 in public markets in hedge funds. And there we're typically funding, the Goldilocks is about a third of your final close, because we don't want to be too big so that we're an bearing LP. But we allow you, we forgo concentration limits in your first close, so you can start building the portfolio, and then we can also allow you to warehouse deals as a fund as sponsor, then committing them to the commingled vehicle. We're flexible, but there we're trying to get you going on your first time fund in that private structure. Obviously, first time funds in privates, you have a vintage based type of GP, and in hedge funds in public markets, you have an open-ended type of GP. That's hopefully helpful of kind of how to think about ticket size and what type of investment you should be thinking of when you're starting your business. If you're caught in that middle ground, as you describe, I mean, I think once you get over 100 in public markets or a couple of hundred in private markets going into your second fund, it's a lot easier. There are institutions who do operate in that sort of 300 to 600 space, and there you can use tools like strategic benefits, right? So certain fee discounts, certain capacity reservations in future products or future vintages. Co-investment flow is something that we recommend using wisely, which makes it quite interesting for some of the allocators to get involved. Co-underwrite with you, get to know you in that deal-by-deal basis, both in public and private markets. Obviously, some strategies don't lend themselves to co-investments as well. Those are the kind of tools that I would recommend using when you already have some money. Maybe you don't want to give up shared ownership, but you can focus on strategic benefits.
Great. Thank you. Anybody else have any questions? We've got about 10 minutes left of the session. Andrew, go ahead.
Yeah. I want to just go back to two topics that Eric brought to the table. First was early on when we were all discussing some of the other organizations out there. I did want to just share with the group groups known as SEO, or Seizing Every Opportunity, is a great organization that we've had some connectivity with. Provides great opportunities to kind of break that barrier that we've all kind of been talking about, especially early on for even high school collegiate graduates to get into high pedigreed firms that, as Eric, I think, eloquently described, is often, filled with much nepotism and opportunity where paths are paved for people. Second, I'd also like to say thank you, Eric, for bringing a candid perspective that career risk, often from allocators, is one of the biggest detriments. I think in our 3.5 years and the work that we've been doing, I think my partner and I found that's been one of the largest challenges from the other side of the table. And I do hope that there's a fundamental change more so that goes underway, where that shifts towards rewarding seeking opportunities and seeking diversity across managers. Again, from all of the categories I think you described as really the mosaic.
Yeah, and on that note, no, not to interrupt you, I think putting career risk on the table, I think, is a very effective way of diffusing it. Absolutely. So obviously me as an investor, I have my own career, and I can seek to not protect it as much, which is what I've done since I started working. But for allocators, what you can do is, look, I understand we are higher risk for these reasons. Let's set up a structure that rewards you for taking this risk.
Yeah.
And you can either offer economics in your firm, which is how I solve that risk premia issue, or you can offer strategic benefits, which is the other toolkit that I mentioned. Discounted fees that go down with AUM, co-invest at 0 and 10. There's a lot of tools there. And I think another two things that we tend to describe at board meetings and ICs with the large institutions that we have the honor of being fiduciaries for is, communicate and telegraph up the totem pole that this isn't 100% hit rate business. So we do expect error and failure. And second, as a corollary to that logical statistical corollary, you need to build a portfolio, because if you only do 1 or 2 investments, unless you get very lucky with your sequentiality of fate, it's likely that you won't succeed. So I think you need to build a portfolio, and obviously, given the asymmetry of outcomes, if you have a portfolio, you should be expecting a positive outcome, but you need to have those conditions. So I think it's something that, it's almost like a subtle way of putting on the table the issues that LPs have that they don't tell you, because the structure of the industry is such that there's no reward for the LP to tell you what they didn't like either, right? They just give you positive feedback and tell you to come back when you're big, because they want to reserve the right to give you money if you turn out successful. So there's no incentive to give you critical and constructive feedback. So if you can start with it, I think it's very powerful.
Agreed. I agree. I just want to say I agree completely, and I think that that's another attribute of this the conversation that has been had, as you have also emphasized, is getting louder, and that is obviously a very positive area of change that's underway. But I think you're right. Bringing topics like career risk right to the front of the table, start to change people's mentality for, maybe the next steps they may consider. Thank you.
So are there any more questions that anyone has to ask? All right, well, we might close out the session then, and thank you everyone for your participation.
I think Jenny had one question. No, I think Jenny.
Sorry. Go ahead, Jenny.
Yeah, sorry, I was just trying to unmute myself. Eric, just maybe one last question. I wanted to ask what do you think of diversity at like more junior levels? For example, I myself, I'm an operations associate at Zero Capital, and my colleague Jiang Min, she's an associate in client service. So we're just like curious, maybe what do you think of diversity at more junior levels? Is it important to support that? Because eventually, in order for women to like rise up to higher levels, they need to start from the bottom when they're junior. So just curious on what are your thoughts on.
Yeah, absolutely. And obviously, I think realistically speaking, we have to start there, because there's a lot more talent at junior levels that is diverse than at senior levels by definition. So I alluded to before the promotion and retention part of the equation as distinct from the getting on the ladder and driving the base higher. That part I mentioned, large allocators, or everyone really, but the large ones will have more impact, need to be asking, okay, how diverse is your firm by function and then by seniority? So that's kind of the matrix. And I think diversity anywhere is great. And we find that often it has that ripple effect, right? So you're in operations, your colleagues in client service, but then hopefully you're involved in recruiting as well. And then you will come with different viewpoints that might end up recruiting someone in another function, like the research function or the investment function, that has a diverse background. I think for us, there's often the need, particularly with big institutions and public institutions, to put numbers around things. So like, it needs to be at least 33% owned by a diverse person, or, the leadership and that. I think that's a bit constraining, unfortunately. So we always like to have a more fluid definition of diversity, and do give credit for diversity at different levels of seniority. Yep.
Thank you.
Thank you.
Great. Okay. Well, if everyone doesn't have any more questions, or I think that it's time to close out the session. Thank you so much, Eric, for your thoughts and the preparation that you obviously put in, and the substance behind your content is always very impressive. So thank you very much for the conversation. I'm sure everyone learned a lot and has got a lot to think about for the rest of the day. Enjoy the rest of the week,
or night.
everybody.
Yeah.
Night,
Thank you for having me.
Nice. Yeah.
Good night to some and good morning to others. But thanks so much for everyone's time and
Thank you very
engaged
much.
questions. And thanks for organizing. Take care, everyone.
See you later,
Bye.
guys.
Bye bye.
Bye.